Have you ever wondered how three numbers can literally change the course of how much you pay on a loan by up to $200,000 to $300,000 over the course of your life? Well, if you have ever wondered that, this video is here for you. Moreover, if you have at any point wondered how the heck are they calculating my credit score, look no further. We'll dive into it right here. Hi y'all. For those of you who are new here, my name is Nathan Mohan. I used to advise businesses on how to allocate their capital, but now, after my experience in the business world, I realized very quickly that people, while they could advise businesses on what to do, tended to be a little bit worse on managing their own finances. With that being said, let's get into it. So these three digits I'm talking about, of course, are your credit score. A credit score is a metric that is used to figure out how credit worthy you are. Credit worthiness basically is how much a bank or really the credit scoring company thinks you are going to be a reliable borrower, and or said differently, how much they can put stock in the fact that you'll repay your loans. Now, a credit score ranges between 300 and 850. Really random numbers, but if you are towards the higher end of the range, that means you have an excellent credit score. That usually means you're able to get lower rates on your loans, and you're going to be able to get more types of loans and more creative loans, if you will, for purchasing the same sort of asset. If your credit score is on the lower end, there are usually going to be more issues with securing a loan, or you might have to use insurance to also purchase a property or vehicle or whatever that might be. With that being said, the bands of what's considered a great credit score versus a bad credit score are, you could say, pretty tight at the top and get pretty wide as you go down to the bottom. 800 to 850 is considered a really, really good credit score. Really good, top of the line, top shelf. You've been paying all your bills, you've been doing everything on time, banks will give you whatever you want. The next tier is 740 to 799. This is also really good. You're going to qualify most of the time for some of the best rates out there, and you really aren't going to be out of the market in any way, shape, or form. The tier below that is 670 to 739, which is honestly also a pretty good score. That's really where the average is, and you're going to find out that, again, for most things, you're going to be more than qualified, and you'll probably get the average rate for most loans that you try to seek. The next score out here is 580 to 669, which that's where you're probably going to have to get loans with higher interest rates, and oftentimes you're going to have to secure those loans with some sort of insurance. And finally, there's 300 to 579, which is the massive bottom end of the range, and that's where you are focused on rebuilding that credit score. It's going to be extremely difficult to get any sort of loans at that point. Now, you might be thinking to yourself, this is just a crazy number. What goes into the calculations? How should I be thinking about it? And really, there's, call it 5 different variables that commonly go into a credit score, credit application. Those are, number one, your payment history. And so this is basically whether you are making payments on time, if you're making payments late. If you've ever missed a payment on a loan before, that's the biggest factor. And that's, call it about 35% of what's weighted in your credit score. The second factor, and also another big one, is amount owed. And so what you'll see is if you have a massive amount of utilization on your cards, your credit score will be lower. Utilization is basically, if I'm looking at the credit limit across all of my credit cards, what percentage of my credit limit am I using? If I am at 100% of my credit limit, my credit utilization is going to be through the roof, and the likelihood of me being able to get another loan drops pretty tremendously. The next few factors are, I would call, smaller relative to payment history and amounts owed, but they are length of credit history. So this is basically how long you've had loans for and how much they can see in the system. Underneath that, you have credit mix, and so what are the types of loans that you're getting? And then finally, new credit. Has anyone asked for your credit score? Any professional organization or bank asked the credit bureaus to basically furnish your credit score? With that being said, let's talk a little bit about credit bureaus and how they are used in the banking process to help you secure a loan. So when a bank is going to give out a loan, they need to assess your credit worthiness. And usually how that works is they will go to one of 3 credit bureaus. These credit bureaus basically have your credit score, but also have a list of your liabilities. They have a list of your payment history. They have a long list of your demographics, oftentimes your job. And because of that, they basically have a ton of information about you to determine your credit worthiness. The credit bureaus that you see in the United States are going to be Experian, Equifax, and TransUnion. These companies all purchase their credit scoring, however, from a third party, which is known as FICO. All of these companies are public and traded on the stock exchange, and basically how the process works is one of the credit bureaus buys a score from FICO. The credit bureau then assembles a longer credit report with some of the history that they have based on what you've been spending, job, demographics, etc. And then they send that information out to the bank so that the bank can then finally make an underwriting decision on whether they want to take the loan or not. In either case, the bank then either issues the loan or walks away. Oftentimes there are other parties that are involved in this verification process as well, but in broad strokes, that is how your credit score is being used. So when does a credit score actually matter? A credit score doesn't actually matter that much in the grand scheme of things, outside of when you are looking to get a loan or looking to get credit. And so what that means is anytime you're looking for a home loan or an auto loan, that's when your credit score is super important because it can drive down your costs a bunch. However, if you aren't in the market for a home loan or an auto loan, your credit score is less important. Honestly, even for credit cards, you may get denied from certain cards, but on average, it's probably not as important as you might think it is. With that being said, the last couple of things we need to talk about. Number 1, we need to talk about how to build up a credit score. And then number 2, how you can check your credit score and make sure that you're on track for your goals. To build up a credit score, it's actually not super difficult. The first thing that you should do is open a line of credit. What this usually means is a credit card. For folks without a massive credit history, oftentimes you want to go with what's called a starter card. Those cards are commonly Discover branded cards that you'll see if you have a bank or a credit union. Oftentimes, because you have some sort of assets with them, it becomes easier to get their co-branded cards. And so that's the easiest way to think about getting your first credit card. And so after that, you'll start building a credit history, and usually over the course of the next 5-6 months, you'll build up enough of a credit history, especially if you're paying your bills on time, to start making advancements towards getting mortgages and loans. The second piece here is checking your credit score. Now, checking your credit score isn't necessarily the easiest thing to do, and historically hasn't been super accessible. What you used to have to do to check your credit score was usually you would have to hope that your bank account or your credit card provider would connect to FICO and then look at your FICO scores from there. However, in the current day and age, the best way to check your credit score is by going to myfico.com. They have a free trial available. You can click, and the free trial is available in perpetuity, so you can just keep using that. You basically can get an updated credit report and a credit score from FICO that updates every single month. Experian.com also links and is partnered with FICO on this, and so you can also get that same score and report from Experian. Note, using businesses and or metrics like Credit Karma is not going to match one-to-one with your FICO or credit score, so you're going to have to be a little bit judicious and make sure that you are getting an updated view on your credit score from myfico.com. The last thing about credit bureaus are obligated to give you one free credit report a year. Now, a credit report is different than a credit score. A credit report just shows your history of loans and your history of credit across basically your entire life. And so with that, you will be able to get a sense of how exactly your lines of credit have opened and closed. The credit score piece is not going to be necessarily there, but with that being said, we'll head back to some of our financial 101 content next week. Thanks.